So should we start off? Should we wait for members to join?
I think we should start. We normally start the program, so we'll start off. So members will be joined.
No.
Yeah. So esteemed members, welcome once again to the webcast of your very special board of indirect taxes naturally comes to me. Board of Internal Audit and Management Accounting. On your screens, you have the towering personality of Charanjot Singh Nanda, our always permanent chairman of this committee at all times. Whatever heights he may achieve in the institute's hierarchy, he will always hold this committee dearer to his heart. We also have here Sudip G. Modi, who is the esteemed speaker for this session for today's webcast, and also Gopal G. Jhanwar, who hails from the city of Aurangabad, the city which is known for himkari. If I can be very specific, himkari is a very specific handicraft which is very popular from that particular city, Aurangabad. And we have our secretary of the Board of Internal Audit, Aarti, who is there with us today. Esteemed friends, this is one more session in the journey of the knowledge sharing that we have. As all of you are aware, internal audit is a sunrise amongst the profession. As the statutory compliances, as the tax compliances, as the compliances on many various numerous legislations continue to be on the rise, internal audit comes as a savior to all finance professionals and especially to the management. Essentially, being the management function, internal audit will always help each and every hierarchy in the management to ensure that compliances and all other procedures and processes are in place. Your board this year has embarked on revising numerous publications, which all the publications are brought about by Nandaji and his team in the past, and we are only on the path of revising it, and also coming up with certain new publications. I must mention here the secretariat led by Aarti Bansal for their extreme cooperation and hard work that they have been doing and churning out knowledge sharing materials for all of us. I will not dwell on today's topic, nor on anything more, because we have Nandaji, we also have Gopal Jhanwar, who are going to take us through today. I welcome each and every one of you. I thank our speaker, Sudip G. Modi. In fact, Modi is a very popular name in India today, not only in India, in the world also. In world. So we have our Modi here on the screen smiling at us. Welcome, Modi ji, and Gopal Ji Jhanwar. Welcome to you also. Thank you for sparing your valuable time. Nanda ji, as always, we look forward to your pearls of wisdom and your motivation. Welcome to all of you. Over to you, Nanda ji, the Honorable, currently the Vice Chairman, but our permanent mentor in the committee.
Sure.
Thanks a lot. Thanks a lot.
Thanks, sir. Thank you, Rajendra ji and Charanjot ji, Aarti ji for the nice introduction and giving me this opportunity to give my views on ERM and how the industry.
Sir, before you speak, Sudip ji, Nanda ji will give some remarks and then Jhanwar ji will speak and then you'll be invited, sir. Yes, Nanda ji.
So very good evening, gentlemen, Honorable Chairman of the Board, C.A. Rajendra Kumar P., who hails from Chennai, the GST man, a man who has changed the entire perspective of this board by bringing in newer ideas and, more importantly, roping in government agencies to be trained so that they're able to effectively carry on the concept of risk management and, more importantly, the concept of internal audit to add value to the management's perspectives. The speaker of the day, C.A. Sudip Modi, who hails from Mumbai, a learned speaker who would speak largely on the subject, and I would like to say something about him. Mr. Modi is a director with one of the very leading consulting firm. He has having wide experience in risk assurance, process transformation, and business consulting, and he is handling manufacturing, logistics sector. Apart from this, he loves technology and taking seminars. A people's man who is very happy to assimilate the knowledge and, more importantly, put at rest all the doubts that may have crept over the years. the moderator of today's session, CA Gopal Zawar, who comes from a very beautiful city called Aurangabad. We have a council colleague, Mr. Umesh Sharma, who also comes from Aurangabad. So Mr. Zawar would be taking over the proceedings of the day. The secretary of the board, CA Aarti Bansal, who has been the secretary for so many years, and all participants have come here to go home more enlightened. Ladies and gentlemen, one very important thing which one needs to understand is the meaning of enterprise risk management. Mr. Sudip Modi will take you through the entire function, but we need to understand that internal audit essentially is a management function. How to strengthen the control environment, how to ensure that the enterprise and all employees and resources are totally risk compliant. Mitigation of risk when it comes. A gentleman came and said, Mr. Nanda, I want to do a job which is totally risk free. I said, my friend, I'm searching this for past 40 years. When I know, I will let you know. But as a passing remark, I'll tell you, where there is no risk, there is no reward. You have to take a calculated risk and at the same time create value and worth. So Mr. Modi, through his great experience and more importantly, through his insight into the subject, will bring out certain pertinent points. How we can use enterprise risk management to add value to the perspective of the management. I will not stand between you and the learned speaker. So ladies and gentlemen, I withdraw. But I want to tell you that the board, under the chairmanship of Mr. Rajendra Kumar P, is ready to always put any seminar, any technical topic which you want. I invite the members of the profession to kindly be involved in writing articles for the board, writing technical guides, writing standards and being monitors where standards are being reviewed. So we have host lot of activities in the board and I invite all the membership to kindly join hands and extend support to your honorable institute, the Institute of Chartered Accountants of India, which was set up an act of parliament way back in 1947, when the most important document to the democracy, the constitution, was not adopted. Not speaking much, I give the dice back to Madam Aarti Bansal and she can take the things forward. Aarti, the dice is all yours.
Thank you, sir. Good evening, all the participants. Now I request CA Gopal Jawar to introduce the faculty and move forward.
Thank you, Aarti ma'am. Good evening, good afternoon, everyone. Myself, CA Gopal Zawar. I'm working as risk and control lead in one of the American banks. Firstly, thank you so much, everyone, for taking out time for this midweek webinar. And thank you, Rajendra sir. Thank you, Nandaji, for those insightful words. Moving to our resource person for today's session, CA Sudipji Modi. So, as sir mentioned, Modi is the name everyone is talking about nowadays. So, Sudip Modi is a chartered accountant and director in one of the big four firms handling manufacturing and logistics sector. He has handled various roles in banking as well as in internal audit and in risk management also. So he's having vast experience in risk assurance, process transformation, business consultancy. I'm sure, Sudipji, your journey of changing the shoes from third line of defense, which is internal audit, to second line of defense, which is risk management, was exciting. So although ERM is a vast topic to discuss in one session, but I'm very positive that Sudip sir will do the justice by explaining the crux of the matter in a very lucid language for all of us. But to set the context of the session, we can say ERM, which is Enterprise Risk Management, which is the topic for the day. What does it mean exactly? So ERM would be like risk assessment while achieving the strategic objective of our organization. Whatever the objective we have set as an organization, the holistic view of that particular roadblocks while achieving the objective of those of the strategy which I have set, those assessment of those roadblocks would tantamount as enterprise risk management. Since we started this session by good conversation of Bharat and Ram, I would like to give very crude example in ERM, but which is related to Ramayana. So if you are aware of Ramayana story and if you know who Jamwant was, then you will recollect this instance where at the beginning of the war, when Vibhishan came to join hands with Lord Rama, and he said he wants to fight against Ravana. So Rama announced that post invasion, I'll make you the king of Lanka. But all of a sudden, the bear of the Vanar Sena, which is Jamvan, so he was the risk manager of particular Vanar Sena. So he arises, and Jamvan says to Lord Rama that if you have decided to make Vibhishana as the king of Lanka, but what if tomorrow Ravan comes, he surrenders, he says sorry, he returns back Sita to us and asks us, please go home, please do not invade us. Where will Vibhishana go? Vibhishana cannot go back to his homeland because he has already come join and to our team, and we cannot fulfill our commitment because we are not invading Lanka. Then in that case, what do we do? That is the risk he has assessed. So that kind of risk management is the thought line. Just to continue with the story, very charming answer which Lord Rama gave. That Lord Rama told him that I will, in that case, I will give him my Ayodhya. Again, our risk manager wakes up. He says, how can you do that? Because Ayodhya belongs to Bharat now. It is no more your Ayodhya. Then Lord Rama again thinks. Lord Rama says, okay, in that case, I will give him my Vaikuntha Dham. And then Jamvan says that as per our records, Vaikuntha Dham is the only property you have, sir. If you give that property, where will you stay? And then Lord Rama says very beautifully, very lovingly, that I will stay in Hanuman's heart. Setting aside the story, but thinking from the risk management perspective, how and where risk management can be used, how pivotal role enterprise risk manager can play in an organizational success. Considering this holistic view and also knowing thoughts and guidelines from guidance from Sudipji Modi, so I'll not take much of the time, but I'll just say it is very important in our day-to-day life that how we can get involved in our in enterprise risk management. So with this note, before our audience dozes off with my blabbering, I would hand over to our eminent speaker, Sudipji Modi, and I would request all the participants to post their queries, questions in the chat box, which we can discuss at the end of the session. Over to you, Modiji.
Now, first of all, thank you, Charanjot and Mr. Gopalji, Aarti and Rajendra for the platform you have provided to disseminate the whatever learning I have got during this course of my career. Last 13 years I've been in this domain, and I really like the story you portrayed on Ramayana, which I believe it's true, and it's a learning for us. Before we do any exercise, we have to define objectives and evaluate the risks to have a balanced decision and oversee the obstructions which are there in our path. So before I even present the slides, I'll set a context to it. So ERM is largely a macro view of the things you see in organization and align that with the objectives. So in the session, I'll keep it to the live examples. Whatever I see in our daily lives, I'll try to link it to that, so we have a better understanding rather than a textual thing. And in my experience, I have done ERM reviews for large MNCs, oil and gas companies, aviation companies, retail companies. Maybe I've been fortunate enough to get such exposure in my last 10 years of career where I've been specifically working on ERM engagements. So for foreign there are multiple dimensions to it, how we see ERM. So in this session, we'll restrict only to the framework level thing and how ERM works in any corporate organization as a second line of defense. So there are various other layers to it, other dimensions to it. We'll try to, I'll give you some highlights of it, but then These will require separate discussion altogether. I'll just present the screen and then we can start off. Yeah. Yeah. So today the agenda is to introduce what is ERM, what does it mean, and what are the elements which are covered in ERM framework, how this framework has to be implemented, and how we assess the maturity of this framework. So we are trying to cover entire life cycle of ERM framework, and not just from the what is ERM, but also implementation and its maturity assessment. So I'll try to give an overview to it, and with some live examples which we face in a day-to-day life, and we see all across when we meet our clients or we run our businesses, we see all across in the ecosystem. So what is an ERM? So enterprise risk management. So this is a bit different from internal audit. Internal audit, largely we are more into the process audits. We understand what are the business challenges, what are the processes, gaps, weaknesses, operating effectiveness, failures, design gap in the processes. If we do an internal audit of a procurement function, largely our focus is on finding the gaps in the procurement function, whether three-way controls are there. So largely the risk we want to find out is a design risk or process risk. But ERM is different. ERM largely is enterprise risk management. As the word itself says, we focus on enterprise risk. So and how enterprise manages risk, whether it's a process risk, whether it's a strategic risk, whether it's a sector risk, whether it's a financial risk. So how collectively the organization is managing that risk. So it's not, but then it's not about risk identification or management. It's more to it. It's enterprise risk management collectively means how we manage our culture. It's very important. Culture decides the destiny. There's an important saying: when your strategy goes for a breakfast if you don't manage your culture. So it's very important to manage a culture, what risk culture you have in your organization, whether decentralized, centralized, middle management, lower management, how they see the things, are they empowered? So there are a lot of things in the culture, capabilities, what resources the organization have, and what resources they can get through joint ventures, mergers, and everything, and what are the practices they follow to manage risk. These are integrated with a strategy setting and performance. So it has to integrate with the objectives of the organization. For example, if tomorrow if you want to become from a startup, if you want to multiply it to 1,000 times, definitely risk appetite has to be high. You have to have a different strategy. Technology may be a centerpiece of it. Whether you have the right skills to manage that, whether you have the right expertise to manage that, whether you have a right target audience to enter into it. So first, if you see the magnetic north of this entire conversation is what are your objectives. I have seen multiple cases, multiple times the organization failed to determine what are the enterprise risks because their objectives are not clear. They don't know where they will have to go 2 years down the line or 4 years down the line. So it's better to have your strategies in place, your visions in place, your missions in place, and then work backwards to understand what are the roadblocks that will prevent us from achieving that. But I'll give you an example. Maybe some of the things for Reliance. Reliance wanted to go multifold in energy business. Okay, but at the same time, oil and gas had its own challenges, ESG challenges. So they have diversified into other domains, clean energy, everything. But how can they do it? Because their objective was very clear on a day one. So it's important to have clear objectives, and then how you place the success of ERM also depends on how you place it. This is a business tool. This is not a compliance tool. You cannot take this as an internal audit or any risk management activity. It's a risk management activity, but on an enabling side. Here, the objective is to identify what are the strategic challenges or what are the major risks an enterprise will face it, or as a roadblock, and to derail them from achieving the objectives. So it is very important that we should have a right perception of this activity rather than taking it as a mere compliance exercise. And it also enables in a risk-based decision making. It's very important. See, there are a lot of uncertainties, and as a decision maker, you have to take a decision where you don't have a complete information. I'll say Amazon. Amazon was clear there were a lot of risk, whether geographical risk or compliance risk or strategic risk or technology risk, but they were clear in their head. Okay, technology is going to drive, internet is going to drive, and we have to become a global company and number one company in the e-commerce sector or in logistics sector with the entire supply chain and other e-commerce platform, and they have to be a technology company. So they were very clear. So again, that really helped, and they had collected the data point, they deliberated it, they evaluated risk and pros and cons for effective decision making. So this effective decision making is further enabled with a lot of committees, risk management committees, steering committees, where we collectively evaluate the risk, pros and cons, and then take a direction. Okay, accordingly deploy the resources to achieve these objectives and mitigate the risks. I'll try to give some live examples. We have discussed this. So what is ERM? Why? What are questions it tries to answer? First question is, what is the risk organization faces? For example, if you are an aircraft company, definitely tomorrow if you are SpiceJet, 1,000 fleets of Air India and Indigo are coming. So that is a risk you are going to face. Or maybe if you are a logistics company, infrastructure is changing. You cannot simply be there as in an aviation business or air cargoes. You have to go into the surface cargoes. Or maybe if technology is changing, you have to change accordingly. For example, Tata Sky, Netflix is coming out. It was capturing market. So what risk organization faces? That has to be first collectively recorded, okay, identified, and then discussed. Which operations, again, that it may be at enterprise level, it may be an operational level, from maybe like major HSC risk, health and safety risk at certain plants, or ESG compliance risk if your plant is located near the city. So these are various questions you have to evaluate, and at the center point, you should have your business objectives, and you have to evaluate the risk accordingly. Which risk will give you sleepless nights? Maybe Nokia, they were not able to adopt technology. They are out of the business right now. And finally, who is responsible for this risk? It's equally important to identify the real stakeholders. For example, we were discussing yesterday with the process owners, who is responsible for business continuity planning, who is responsible for cyber risk. Management didn't have any answers to it. So it's very important. Meanwhile, you identify the risk, but also identify who is responsible for it. So there will be new risk, competition risk. It's a risk, but really, if you ask the management who is responsible for it, everyone will see MD will point out towards MD. No, it's equal. You have to identify whether every action, you have to break up that risk and identify whether marketing team is equally responsible, HR is responsible. You have to bifurcate the responsibilities to the risk you pose that the company faces. So risk owners have to be defined in that case. Next is how you manage the risk. So first, so management of risk is really important. You have to find the mitigation plans. What are the existing controls to it? What are the gaps in managing the risk? And accordingly define your 90-day to a 3-year plan to it. So, and whether you have plans which are adequate. For example, if entire retail industry, brick and mortar industry, retail industry is moving towards e-commerce, whether your investments are adequate to manage that competition, which existing players will give, what USP you will bring, how you are going to brand. So that are certain questions you have to evaluate as well, whether these are adequate to manage the risk. And again, I said, there will be certain risks which company cannot manage, but that has to be on the radar of the company. For example, forex risk. Forex is something company have to deal with it. You may not be able to hedge everything every time. Hedging may be a costly affair. It may be forex or commodity risk, or in case of transportation, diesel prices and risk, it's uncontrollable. But then you have to find an way at what level what impact is going to have on an organization. So next is monitoring of risk. Once you identify this risk, you have to monitor the risk. It's important because whatever plans you have determined, it has to be monitored and have to be reviewed on a periodic basis. Otherwise, this doesn't make a lot of sense if you keep on identifying risk and these remain unresolved. And it does not realign your business objectives, resources, or your strategic goals. If it's not getting aligned, then the entire exercise loses gravity, and company may lose its direction. I'll give you a fine example on that side. Maybe BlackBerry. BlackBerry was knowing that Android is coming up, but they chose not to monitor that risk, and it had its own consequences as on date. So really, these are some of the things you have to know and be on top of it, whether you are a consultant, whether you are a process owner, whether you are a management personnel, because you have to know which are the things which will give a sleepless night to the management. So that is it. Now coming from the compliance side, okay, we said it is a business tool, but from the compliance side, it's equally important. And that has been, so ERM is one business tool which has been acknowledged by our authorities as well. Maybe it's Companies Act, whether it's SEBI, all have recognized that this is an important tool to manage the risk and continuity of the business. Okay, so it clear. So you can see a Companies Act section 134 clearly wants directors to certify whether they have a risk management policies and have identified the risk and are managing the risk, which are going to have a threat, which have to have a significant impact on the company or may threaten the existence of the company. So it's a director's responsibility. Whether you are listed top 1,000 company, whether you are public company, unlisted, or private company, all are responsible. All the directors are responsible for that. Now comes audit committee, where audit committee is responsible to evaluate the internal controls and risk management systems. Internal financial control may take care of your financial statements or your process objectives, but then there are some risks which has to be managed at an enterprise level and strategic level as well. We gave you certain examples. If you have a sector risk, your internal control system may not be able to take care of it. If there is a sector risk, maybe today oil and gas is facing a lot of ESG compliance risk, which is coming from the international authorities. Or in aviation company, they are facing a lot of pollution norms. Then you have to find a way out. Or in our case, manufacturing company, suddenly their products are losing the market. How you will get into it? A retail company. In our case, Walmart didn't succeed in India, but then he is doing well with Flipkart. So risk management is equally important. It's not just about internal controls. Now comes again the independent director responsible. They have to certify whether their systems or internal risk management systems are robust and defensible. So Companies Act Schedule 6 has made them responsible for it. Also, SEBI LODR have clearly given a mandate that board members have to assess the risk and ensure that risk minimization procedures are there, and risk committee is already also in place. So there were certain changes in LODR requirement last year. So now with new LODR guidelines rules of 2022, top 1,000 companies needs to have a risk management committee as well. They have to maintain risk management. They have to evaluate whether risk frameworks are right, whether they are having mandatory meetings, quorums are there. So a lot of responsibilities are being placed on the independent directors, board of directors, management of the companies. So this is, you have to see risk management as an important business tool for corporate governance as well. If you have to be future ready, ERM is a go-to tool. So I'll give you certain example. Right now, the whole point is why ERM is important and why we should spend our next 30 minutes for this session or next 1 hour for the session, whatever time you want to invest. Why? I'll give you an example. GE was very important client of Infosys in 90s. They accounted almost majority or 1/3 of the revenue of Infosys. So that was really good. If you have a client which gives you 1/3 of the revenue, that is good. But on the hindsight, there's a risk. Tomorrow, you don't have the bargaining chip with the client. You have to work at their rates. And if tomorrow there's something happen, and client goes away, that clearly raises a question mark on your existence, your competitive position. So that thing, so this was one of the risks which Infosys clearly marked out in 90s. And they worked around that. They expanded in European markets, South Asian market, Chinese markets, Africa, a bit on South African market as well. And they were able to bring it to less than 10% in next 10 years. And eventually you want to see add more thing. There was a time in 2000s and they had to, there were some pricing issues and something, and they had to, and if they had to part away with GE. But then that thought that too much dependency on GE was, and it has to be remediated, was very important. See, many of the risks will take 10 years to mitigate, but it has to be on a management radar. There has to be continuous effort on it, and you have to define the strategies, your policies, your practices accordingly. I'll give you another example. This is a failure. You saw a success. This is a failure. So Lehman Brothers, everyone knows about it. But what really went wrong? There are multiple reasons to it. So I won't say there were certain process lapses, everything. But if you have to clearly see, there was very high exposure against the property derivatives, and there was a loss of property prices, and then they lose their investments accordingly. But then failure on the ERM side, there were no early warning signals. Okay, if you first of all you have to identify risk and you have to monitor it. It's not just identification of risk; it will resolve your worries, remediate all your worries, or the things will go hunky dory. So there were no early warning signals which were tracked, discussed. There were some irresponsible leading practices in ERM management. Okay, there were no robust risk committees out there. Risk registers were not updated. So you can see there were lapses out there which had to pay a heavy price. Not just the management, even the employees, investors, entire ecosystem, and I'll say entire world had felt the brunt of it. So you understand this is an important exercise, and we have to do it in a right way to give the most value to our clients or to our stakeholders. So right now I'll give some more examples. So these are some examples, successful examples of Indian ecosystem. You could see oil and gas till 2010, 8-10, there was heavy in Reliance Industry had a very high dependency on oil and gas sector, but then they realized with ESG coming out, oil and gas sector is not going to be there because with global warming, climate change, investments are going to be difficult, market pricing is going to be difficult. Okay, so yeah, they evaluated the strategy, the risk. Risk is, see, as a human or anyone, risk comes very natural to us because we want some security in life. We do, and that happens. The risk is very natural to us, but then there has to be a framework around it. So that is what we are discussing. So you see, Reliance have now diversified into media, retail, green energy, They have completely de-risked themselves from oil and gas. Now that share is less than 20%, 30% of their entire product portfolio. Same was with Tata as well. Tata had a real tough time in managing debts. Tata Steel was completely under debts. Tata Motors were under debts. And innovation was not there. Tata Motors had a real tough time in innovating their products. So they increased their focus on that. They have went on innovation, and you can see the market benefits in these years. They are coming out with the e-vehicles. They have restructured their debts. The cost of debt has gone down. And I'll tell you one of the key examples, which is another L&T. L&T had done an amazing work in infrastructure, everything. But then infrastructure was not doing good in 2008 to 2014. There were reasons to it. Bureaucracy was there. Ecosystem was not friendly. Then unstructured business. There were challenges to it. Government policies were bad. That was impacting their growth. So in 2000, and L&T took a conscious call. They will diversify into IT services and technology. You want to see how it has impacted them as an organization? It has so L&T has a valuation of 2 lakh crore. It took them 75 years to build a valuation of 2 lakh crore or 2.5 lakh crore. But then in IT services, you can see Mindtree, L&T Infotech, L&T Technologies. They combinedly created a value of over 1 lakh crore in last 10 years. So these were some strategic calls. They took it. Given that risk, the business L&T, the infrastructure, they had a sector risk already. What are the sectors they foresee coming up? Same with oil marketing companies, ONGC investing in oil, natural resources. So you can clearly relate it. They identify the business objectives, they identify the risk, and accordingly plan the mitigation plan the strategies, mitigation plans, allocate the resources. So it's more of a strategic tool rather than a compliance tool. So now the whole objective is, what do you mean by ERM? What is the components of this ERM framework? For instance, given that its importance, we have to understand what does the framework consist of. So ideally, it consists of structure. So you need to have a structure, organization structure for ERM. You have to have a defined policies and procedures, and then you have to implement them. So in an ideal world, this is an illustrative case how an ERM structure of an organization look like. First, there's a board. Obviously, board is the accountable thing. Companies have clearly given them the responsibilities to oversee the risk and entire risk management framework. Then comes the risk management committee. So risk management committee constitutes of the representative members from the board of directors. Ideally, new Companies Act, new SEBI guidelines want that at least one board member should be a part of independent director. A board member should be a part of the risk management committee, and majority should be the directors. It should, so again, for coordination, day-to-day affairs, risk management, for procedural things, the committee will be supported by chief risk officers. Okay, and below that there will be a steering committee or risk management council at a functional level. Because what really happens, based on my experience, many risks, something like competition risk. Competition risk is not just a worry of marketing team. No, it is also a worry of finance head and maybe a technology head and also production head. If you have to compete in the market, you have to have a mitigation plans across the functions. It's not just how you develop a new product, but also whether you have the technology edge. What is the gap between your competition or what is your technology vision that may be serving as a USP. So again, that also pulls an information technology guy. Maybe from production side, you may have some edge. Okay, you are making a quality of the product. Definitely, production person will come into play. So to manage the risk, you need a collaborative effort as well, rather not just an individual effort by a particular process owners. For that, uh, a risk management council is created. There is no obligation as per the Companies Act to create the same. Unlike risk management committee, who meets every 6 months to oversee the risk management council is largely a management body who collaborates to identify the risk, to evaluate the risk, and also recommend the mitigation action plans. So that is the whole objective. Uh, and then there are risk coordinators which are appointed by each risk owners. The HR department may have a risk champion who knows the processes, who knows the risk. Something like he will keep on tracking attritions of the organization, employee attritions, then uh, salary composition, salary of the employees, raise in wages. So every HR department will have certain champions or coordinators they appoint to to track and keep recording the risk and collect the data points for the meetings and update the risk registers. So now, what I'll just give you some pointers to it. What is an expectation of SEBI LODR, and what does it? What are the responsibilities of risk management committee? I spoke. I've given you some overview in the last slide present just a minute ago. So largely, SEBI LODR wants that risk management committee should have minimum 3 members, and majority of them should be a board of directors and one independent director. It is very important to have the independent view. Okay, it's so independent. So that is clearly required. The new SEBI LODR clearly requires one independent director, and risk management committee has to meet at least within 180 days between two from the last risk management committee meeting. So that gap should not be more than 180 days. Again, there has to be a disclosure in annual accounts. So on brief composition of the committee, brief description about the members, name of the members, who are the chairman, how many meetings you have conducted. So this has to be reported in your annual reports as well. So SEBI LODR clearly want top 1,000 company to be compliant on these matters. They have also given some guidance on the risk management policy. Like you have to have a framework for external risk, internal risk. You have to classify the risk into financial, operational, sectoral risk. And more importantly, where the conversation is happening is ESG, your environment, social and governance related risk, and cyber security risk. So these are very important elements. Every boardroom, we see a discussion happening on ESG. What are the plans? Since we have to understand, India has given some commitments. There are 2070 commitments. There are 2050 commitments. Now, even your all stakeholders, whether it's customer, whether it's your investors, everyone wants to have a view whether you are ESG compliant. Investors are not ready to invest in your company. Customers are not ready to buy your products unless you are ESG compliant. It doesn't mean just on the environment side, whether you are using not using plastic, whether how much you are decarbonizing your company. No, also from the labor law compliance perspective, what are your top corporate governance policies? So largely that framework has to be there to provide the comfort to the all the stakeholders from risk management committee to your shareholders. Cybersecurity has seen a tremendous rise. Maybe post COVID, we have seen every company wants to evaluate the cybersecurity risk, and it has to be a part of the discussion in your risk management committee meeting. Also, business continuity planning, that is the third apart from ESG and cybersecurity, they want to know on the business continuity planning, whether you have framework, whether it was evaluated. So this is a mandate given by the company, your new SEBI LODR 2022, whether the discussion is happening in this domain as well, and whether it's on the radar of your risk management committee. So there was some so again the other elements is other elements as your chief risk officer. So there's a new opportunity for all chartered accountants, not just to look for a CFO's role or an internal audit role, but also risk chief risk officer. So we can find out. There are more opportunities which are coming our way. So traditionally, people used to go for CFO or audit head role. No, this is more dynamic, and this is more important. This is more future ready role. You have to make the company future ready. So the role is that completely evaluate. You have to make have an inventory of risk registers. You have to convey risk committee meetings. You have to monitor, define. You have to oversee the entire risk management function, enterprise risk management function from monitoring of implementation plans, defining early warning indicators. So you can see a lot of things out there happening on that side as well. Again, the risk owners. Risk owners are largely the process owners, business heads who are responsible for the risks. They have to maintain the risk registers which are relevant for the department, have to track the implementation plan, have to report the risk to the CRO and the risk management committees or councils. So again, to set a constitution to it, companies define the risk management policies and procedures. So it defines the structure. Then how are the entire framework? How are they going to record the risk, monitor the risk, track, evaluate the risk? So entire thing is defined out there. They define the scope of the policy and how frequently it will be updated. Then we discuss the risk management structures, what are their roles, responsibilities, and the risk management process. How they're going to identify the risk, more importantly, how are going to assess the risk, prioritize the risk, and subsequently have a mitigation strategies and reporting and monitoring of the risk. So these are the elements which are generally covered in a policy. A good policy should cover all these elements and have both quantitative and qualitative information to it. As a next step, we'll discuss this risk management process. We understood that from a risk framework perspective, you should have a structure, ERM structure to it. You should have a policy to it, but then this has to be implemented on the ground. On that, now we'll discuss on the implementation stage. So before we move to the do we have any questions around that? Anyone having any questions on that side?
Sudeep sir, if you want, we can take questions at the latest part, or there are a couple of questions. So if you want, we can take it right now, whatever you wish.
No, we can take it. Maybe if it's coming.
So one of the questions.
We can take it at least other than having a monologue.
Understood.
We can
so one of the question which Venugopal had posted is that what are the challenges in convincing the board that ERM is beneficial to the company, as there are many companies where big stakeholder companies, but still they are yet to set up the ERM as a proper unit, or they have just now started. So what are the challenges to convince the board to set up the ERM?
See, it is what really has happened. People are getting confused between internal audit and an ERM. The first is you have to understand, if many companies do internal audit and they believe that this is it, they're taking care of the risk management activity. Okay, they have to enlighten. Okay, there are certain risks like competition risks. It cannot be taken care by just having an enterprise risk by your internal audits. No, your focus will be on a process, on a system and technology side. But how as an organization to manage certain external risk and internal risk. Okay, that is very important. They are a part of discussion in some shape or form or another. But then, how structurally are you evaluating it? Do you have a proper structure to identify all the risk? Each one may have their own limited view to it. Maybe a technology guy may see technology as a risk, safety officer may see a safety as a risk, or one may see other function as a risk. Challenge what really happens is collectively are they seeing the sector risk? Okay, are they prepared to manage this? For example, I'll just give you an example, and I've had a real life learning on that. So right now, I'm working with one of the startups. Okay, I clearly see marketing. So they are a NBFC and financing is something they are into. So they give the financing and everything. But then say, the person who is in loan giving loans is really worried about just giving loans to the employees. Okay, to the who a person applies for the loan. But the real risk is like cost of capital. It was not getting monitored and discussed with the marketing team. Okay, the cost of capital is rising, so we cannot give the loans at maybe softer rates. The rates have to be increased. But then, so ERM gives you that forum. Okay, that gives you that forum that everyone becomes a part of the problem and everyone contributes to that. So it becomes a forum, and many organizations doesn't have that proactive way of communicating and manage the risk. Maybe I'll give you another example. Attrition is a risk. Aviation industry is seeing a lot of pilot attritions and new companies are coming up. Indigo and Flight Jet Airways are having 1,000 aircrafts. India has 700 aircrafts and there will be 1,000 aircrafts. So pilots, now they have to collectively see whether there is adequate pilots available in the market. What is their strategy? How as a brand they have to place themselves to acquire pilots. It's not one person responsible, but there are certain risks. At company level you have to see. Okay, and you have to scan that risk. And maybe I'll add another example. You see a lot of chemical companies, okay, and everyone is busy in their life. As I was doing an ERM was of a chemical, everyone was busy in their life. Their job was to just increase sales, but then they never knew there was a new risk coming up on that certain chemicals won't be allowed there in the next 2 years, and they were not ready for it, and that was main ingredient in whatever chemicals they were making up. The external scanning of risk is important. Somebody has to be really tracking risk, no? And there will be opportunities as well. Huh? It's not just about risk; it's about opportunities. There will be certain guidelines which will promote the businesses. Okay, you have to track that. Your competition will track it and take a leverage on it. So it has to be a more of a discussion forum where people will come and contribute, identify risk, and manage it. So I'll come to, because you have a limited resource. You have to manage your top 10 risk only. You can only manage your top 10 risks. You cannot manage all the risks definitely, but then your resources will get certain direction. If tomorrow, yesterday, L&T thought that, okay, they have to go into IT segment, somebody must have thought, na, ki infra was doing really bad under UPA, very honestly. Every project was stuck up. Somebody had to take that call. Everyone, so collaboratively, you identify risk, accordingly allocate the resources. Otherwise, they would have continued their infra business. So that decision, it's a decision-making body as well. Huh? It's not just about managing risk. It gives a proper forum to monitor and manage the risk.
Makes sense, sir. Makes sense. Thank you. Thank you so much for the elaborate answer. Venugopal, I believe your that answers your question. Moving next to there's one more question from Mahesh, Sudeep sir, which says that level 3 function head does not include internal audit. I guess in your previous slide, there is the one diagram. So in level 3 function head, it does not include internal audit. Why? Is I part of ERM or not?
See, I is different from ERM. Yeah, ERM is a second level of defense. Organization have it, and internal audit is the third line of defense. Ideally, both should collaborate. I cannot have my scope of internal audit defined unless I know what are my top risks of the company. You have to know top risk of the company and then define the internal scope, and vice versa. If I'm getting certain key findings, it has to be evaluated whether it's an enterprise-wide risk. But I say attrition of company, that may be a triggering point for scoping of your for defining your internal scope. Huh? And I'll pick HR as a pain area. Maybe something HR is not doing right. They're not give turnaround time of for hiring, or they have a manual process. So there may be external reason or internal reason, but then you will relook their processes. And vice versa, your internal audit has a finding, okay, HSC is a big pain area of a company. Health safety is a pain area of a company. And there has been an observation across 20 plants. Then you have to prioritize the risk. You will say, okay, you have a lot of findings there. There may be a lot of impact, potential impact because of this happening. And then people evaluate the risk accordingly. Okay, now it is not just a process risk, but not an operational risk, but an enterprise risk. So it works in both the fashion. But ideally, they don't overlap. Function-wise, activity-wise, they are different altogether.
Understood, sir. I think that answers. But in conjunction to the same, there is one more question from Ranjan, which says that how an internal auditor can re-pivot to enterprise risk manager.
See, enterprise risk management is a tricky exercise. Okay, so I started my journey. You should know a sector well. For enterprise risk management, you should know a sector well, and you should have an enterprise view. You should have an expert opinion on the sector and businesses. So stakeholders are different. How we approach it is different. Here we largely communicate with the senior management, function heads, okay, SMEs from the industry. We see government policies, procedures, how the changes are happening, ecosystem, and then you approach it, okay. Your scope is not defined out here. You have to identify the risk which is relevant to the industry and what it may affect. So that is how, so you have to have an expert view at it. Whereas internal you have to have an expertise in that as well, but then you have a defined procedures for that. So internal is largely your focus is on the process gaps. Okay, you cannot apply the same pivot. So from your journey, you start with an internal audit. You understand the businesses, you understand the process, you have built an expertise in the sector, and then go to ERM. That will give you a platform to run an ERM engagement for your clients or for the management. It's a stepping stone toward doing an ERM. For example, if you are doing a shipping company, you cannot just go and give an expert view. What is the risk a shipping company faces? No. You know your business through internal audits and then engage with the management in enterprise risk discussions. And management wants an expert view, not your opinion. They want an expert view because your view are going to change the shape of the company. That decision will be changed, the resource allocation will be changed, their budgets will be changed, their hirings will be changed. All the subsequent decisions will be changed. And you are guiding them, the larger interest will be directionally it will change. So hope that maybe we can go to the next present slides.
Sure, sir.
And if it's going too hard, do let me know. I will try to be as simple as possible. Is there or should I reshare it?
The screen share has gone, sir.
You are able to see in the full screen?
Yeah.
Yep. So next was how we implement this ERM as a process. Okay. So that is a very obvious question. Then whatever is said and done, as a function, we have to implement this process. This entire framework has to be implemented. That is the more important question. So principally, we have these 5 stages. First, to identify the risk and evaluate this risk, assess this risk. Are there this risk relevant? Okay, if they are relevant, define a response for this. What is our response to it? And then record them. It's important to record them. Only then it will be reported and tracked. Okay, so this entire cycle will be, you have to implement from identification to assessment to response to recording and reporting and monitoring. So we'll see each step how we implement each stages. So how do you what is so you we know what is the so first we have to define what is the risk. Anything that affects that risk is nothing but then anything which may impact our business objectives, any uncertainty which may impact our business objective, whether positive or negative. Okay, you have a business objectives and there is an uncertain event. Okay, so and this so that what is that event which may impact your business objectives and your achievement of objective from desired state to actually achieved state. Maybe in our case, we used to study. Whenever we used to go for C exam, we thought maybe we'll start in 3 months or 5 months, we'll complete the entire curriculum and will appear for the exams and clear in first attempt. So that was the desired state. But actually, what used to happen? Energy levels were down. We noted that okay, there are some other priorities as well. Maybe family members not well, or there are certain uncertainties. We that tuition classes were not happening in that frequency. We're not able to complete their tuition. So there are things achieved from state desired state to achieved state. There are risks. There are certain events that will happen, and you have to manage this event. If you're not able to manage this event, then you'll end up not able to achieve your desired state. So that is how we see this. So definition of risk is uncertainty, the effect of uncertainty for on our business objectivity, on our business objective, whatever events that may impact our business objectives. So how you identify this risk? This may be internal, this may be external. Okay. Now we have to scan both risk. For internal, many companies do it this part very diligently, but this external risk they completely fail, particularly middle management. So ideally, how it happens? What is an internal risk? It may be a strategy. Strategy. So Nokia had a strategy of they want to continue the business and go into the developing markets, but then strategy went wrong. Okay. Strategy. So first of all, you have to have a strategy, whether you have a 3-year, 4-year, 5-year plan. Okay. Then structure. So risk may be from a strategy point of view or structure point of view. Okay. You may not have the people with the right skills or certain things. Certain businesses wanted decentralized process. You have a centralized structure, or there is a conflict in structure. Okay, marketing head is also leading your finance function, so he'll divert all the money towards marketing. So there's a structural issue. Then there's a process issue. Process issue is something like you don't have internal controls, or you don't have the right MISs or right right procedures in place to manage the risk. Okay, then there will be people risk. You don't have people with the right skills. Training is an issue, or your skill set you are hiring is an issue. Awareness is an issue. So that is a people related risk, and there is a cultural risk. So maybe I'll pause for a minute. I'll just have a water and then come back if you don't mind.
Sure, surely. Yes, Sudeep sir has gone for a break, short break. He'll be back in a minute.
I'm back. Oh,
Yes, sir.
yeah, so will continue on that. So largely, so the point is how you. So the risk can be from various sources. Now, external risk can be from various sources, whether geopolitical. If you are going to set up a plant in West Bengal or Kerala, you may have a trade union risk or change in policy risk. For example, right now you can see yesterday. So all automobile vehicles may have a tough, particularly diesel vehicles may have a tough time. There may be a new taxation coming up or new GST law coming up for that. So that is risk. People, you have to scan the risk. So ultimately, the objective is that you scan the risk and what are the sources of risk, whether it's from a strategy or a structure of an organization or it's change in law, change in technology. For example, again, I'll give you an example. So you have a new laws on environment, new expectations of the government from customers on environment compliances, AI coming into play, how AI is going to impact you as such. So these are the risks you have to perceive. So there was some network issue. So these are risks you perceive. Huh. So I've given a case to it may be from various things, from brainstorming sessions, workshops, your for learning, so last learnings, whatever the learning lesson learned during your project management or internal audits, or on that side risk interviews. So there are uh, so ways and means to identify the risk. It may be so research you do out there, in research you carry out, your then your your association, your affiliation to a technical association. So these are certain risks. So there is a call I have to just pick up on. Piyush, I'm giving you just a minute. My apologies for same. So what I have done is, so I'll give you a context how we scan a risk. So for an company, what can be a risk? They're inducting new aircrafts, or their old aircrafts are going out. Maybe there is a change in the freight they are carrying. For an air cargo company, they can explore certain new ways of revenue from chartering of flights, or their security equipment at airport is aging and not effective. There's high attrition of people. So these are internal risks. What are the external risks? Competition is bringing a lot of new aircrafts. Maybe now people may not send their cargoes from air; they will send it from surface. There are new airport coming up. Road infrastructure is improving. So these are external risks. Your other privatization of airport may lead to higher rentals by airport private airport owners. So these are risks. Again, you have to see from the policy perspective as well. There's a logistics policy which has came into play. There's a data protection policy which has came to play. So tomorrow, if you are taking any KYC document, whether you are taking too much of personal information, for again from the global ESG compliances, what are your thing? Whether you have to go ban plastics. Plastics an important component in logistics industry. Plastic packing, whether you're allowed to do. So there are things you have to scan, keep on scanning from various sources, from your industry affiliation, from networks, connects, you're learning from competition. So these something you have to keep on identifying and create a risk repository. So this is a sector risk repository which we create to understand the risk from the sector perspective, from financial perspective, from cyber information perspective, from operation perspective, from ESG perspective. We have to create a risk library on the first stage. Okay, these are the risks which is relevant. Competition is a sector risk, and then for air cargoes, land is a risk, surface transport, new highways, better connectivity is a risk, changing fuel prices is a risk. So that is how you evaluate yourself. Use of plastics from ESG side is a risk. Then again, your borrowing, your rate forex risk, change in dollar prices may impact your for international consignments. Cyber, again from technology landscape, you have to identify these things. So maybe similarly, if you see the risk profile of a construction company may be different from their respective design is a risk, such or budgets are a risk, or cost overruns is a risk. So there, or tomorrow, your project management, maybe project clearances may be a risk, from land acquisition to pollution control. So you have to identify the risk universe which is applicable to your company. That is the first stage. Now comes how you do it. So you study your competition, what risk they have reported. In infra companies, L&T has reported technology as a risk. Okay, project clearance as a risk, then the cyber security as a risk. You have to keep on tracking it continuously. What is your competition doing? What is the landscape? And then you have to customize risk to your thing. What are the relevant risks which is applicable to you? You cannot just pick foreign this as a project clearance as a risk, or maybe finance foreign currency as a risk. You have to set it to your context. Okay, I being an aviation company, forex currency will have impact on our fuel pricing. You have to customize this risk. Okay, aging of fleet is my risk. Okay, I have old aircrafts. I may not be able to carry the thing. Then infrastructure upgradation is my. So you have to customize the risk sector risk and risk universe to your thing. Availability of talent. Okay, for in my domain, pilot is important crew. Other ground staff, it's okay. I'm not really worried upon. You have to customize the risk to your thing and then discuss. Then you evaluate the risk. Okay, the step is to customize the risk. Then what will happen? Next is then you evaluate which risk is most relevant from impact perspective and likelihood perspective. Okay, impact is what impact will it have if it materializes, and what is the likelihood of materializing this risk. For example, earthquake, flooding. So these are, it may have a significant impact, but likelihood is very less. Earthquake happening generally, or tsunami happening, but tomorrow there may be a cyber security. Okay, likelihood is increasing and impact is also increasing. The increased IT landscape, both are going hand to hand. But now the problem is how will you assess whether it's high, medium, low, or what? For that, you have to define a parameters for it. Okay, in your case, what is the measure scale at which you will measure this risk? I'll give you an example. For example, a company assesses, okay, if the revenue loss is more than 2%, then it's a high risk, or medium risk. If between it's less than 1%, then medium. Or example, business continuity. If certain event have a permanent damage, business shutdown, high risk. So maybe temporary damage for 2 months, medium. For 2 days, low risk. You have to set a parameter, impact parameters and likelihood parameters. Okay, likelihood event happening once in a 10 years, once in 3 years, and then rate them accordingly from impact perspective, likelihood perspective, and then define a risk matrix. Okay, these are low risk and these are high risks. Okay. And management largely focus on high risk, top 10 risks. So that should be a focus area to spend your energy on. So there are methods of doing it. You can do it through survey method, send a survey, impact, likelihood, and many companies also believe in velocity, something like cyber. Cyber may happen anytime. Okay, you may not get to prepare. Okay, likelihood is that it may happen once in 2 years. That is a likelihood. Impact is the entire system may crash and you have an impact of $500 million, but it can happen anytime. Okay, velocity. That is another parameter many of the companies have started using. So how prepared are you on a 0 day? That is also important. But then that is not right now happening very often in most of the companies. It's 1 out of 10 companies are choosing that velocity as a parameter along with impact and likelihood. So once you do it, and then you prioritize the risk from 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What are the high risk? And largely, these are the top risks which are discussed at various forums. Low and medium risk are largely discussed at a management level. These are not taken to the risk management committees for their thing. So that again, it all depends on your risk management committee. You want to discuss all risk or top 10 risk. That is how it goes about. Now the next step is you cannot manage all the risks. Certain risks you have to accept and move on. Like forex hedging. We believe that in Indian context, where dollar devaluation keeps on happening, you may not hedge it. Okay, you will accept it. Okay, you are an exporting company. Dollar keeps on devaluating, but then at times it may appreciate it, have an appreciation as well. So dollar price may go from 80 to 85. That is, or it may go to 75. 75, you may face a loss if you are exporting country thing, but then you have done your cost benefit analysis and you continue with that risk. Or you may find that, okay, there are some risks like climate change. You cannot do all things together. You have to accept the risk and go on. Transfer is like you buy an insurance for that. For aircraft company, they buy an insurance and or pass it to third party. Or there are agreements like aircraft engines. They will simply say, okay, maintenance of aircraft and uptime is the responsibility of third party. If my engine gets damaged, immediately third party has to replace the engine. Mitigate the risk. Sometimes you mitigate the risk as well. How you mitigate the risk? Like pollution, non-compliance to pollutions. You shut down the plant and move it to other location. Or you may have a pollution control equipments. Okay. Credit or for example, in marketing, if you believe that credit default risk is increasing, then you reset your credit rules, your credit rules. Avoid is something you discontinue the operation and move out. For example, you believe this has a branding risk. Maybe in case of L&T felt that okay, defense is going to impact my other business. Let us shut down. It might be some companies may do it. The branding may get impacted, so they shut down the business. Or in case of Zomato, they believe okay, we have some other businesses, they want to shut it down. Like in certain markets, it may happen in certain markets. So maybe in Northeast, Zomato believes it's financial loss to them, they shut down their operations. So they simply avoid that risk. So now recording of risk is important. Since we have identified the risk, we are evaluating the risk. We have to record them. Okay. So recording has certain procedures. You have to define who is responsible person to record the risk, and including your impact, likelihood assessment, everything has to be recorded. Only then you can report and track. Ideally, I'll show you certain templates, how we record a risk. So your talent, if talent is a risk, it's an internal risk. What are the root cause? Maybe job dissatisfaction, lower compensation, or career advancement. That may be a reason for it. mitigation. Okay, you have to mitigate it. These are the stakeholders for this risk. And what is the initial assessment? It's a high risk for the organization. Likelihood of impact is high. Velocity is medium. Maybe during COVID, we saw a lot of attritions. So then they felt that impact is high, likelihood is high, and velocity is medium. So that is the risk rating they have given, and these are the control measures company have it right now. And post which these are the risk ratings. Okay, these are residual risk, and how are we going to measure, have a action plan and early warning indicators. So this is something new development happening. You cannot just give that this is my action plan. You have to have a tangible warning indicators. Okay, you have to define what is the attrition of my high performers. Okay, what is overall attrition? What is the region-wise attrition? Just saying that okay, we'll increase the compensation or we'll have a better work policies or we'll evaluate the do employee survey may not help. Now, with independent directors being responsible, people want that each risk indicator, risk highlighted is getting tracked. Okay, so that is how it happens. So now, the next step is risk reporting. So whom we report the risk to. Once we at a department level, you identify risk, it is important you report the risk. If to your risk owners, report the risk to the risk councils or steering committees where they evaluate it. And then again, if the risks are critical, then it is reported to the risk management committees. But reporting of risk is important. So here comes the role of chief risk officers, your policies, your procedures, at what level which risk will be managed. If a risk is of low nature, the risk owners are responsible for it. If it's a medium nature, your risk committees or risk coordination committees are responsible for it. If it's high risk management committees are responsible for it. So that is how your policies have to be drafted accordingly. What risk will be managed or reported to which level and how it will be monitored. For example, these are the risks which were taken to a committee on a fiber optic committee. So they have identified these are all have a 9 scores, high risk. They will be reported to the risk management committee. But again, you have to customize risk. That is again an important element. If you believe markets or marketing strategy is risk, then you have club all the risks which are related to it, and which will have a common action plan. Or in this case, if challenges or anticipating demand is an important risk, or technological description that may impact how we assess the market demand, or we don't have market intelligence, or our ability to have a focused approach on strategy at certain geographic location. Like in India, you don't know how optical fiber will grow, or in African markets, you don't know. So their entire thing is how their marketing strategy will be defined is a challenge. How accurately technology and demand will impact the fiber optic sales or in which geography it will get impacted. So they clubbed entire risk, all the risk identified into one bucket, and then defined the risk card to it. Okay, these are the risks. So these are the root cause you have to identify. So the root cause is that they don't have a market intelligence, or on technology side or the competition side, fiber optic cable. What are the key stats? Where are we right now? Where are we placed? What are the existing measures we have? And what are the action plans for next 2-3 years or 6 months or 3 months? What is the roadmap ahead? So entire risk card is prepared in this manner. And then that will be taken up and discussed in the risk management committee meetings. People will contribute to it. You will allocate the resources. But then just reporting is not enough. You have to have a KPIs. So I'll give a dashboard of a retail company. So they monitor the risk, whether the risk is within appetite or beyond their appetite. For example, DMart. Maybe I'll give an example. DMart. They have 20 stores. The board will like to know if your your inventory damages is within your, how many stores have, it's within limit, 29% it's within limit, 71% it's outside the limit. So severity score. So there are ways and means you track the individual KPIs. Fire safety risk, 29 stores are within limit, 79 is outside the limit. Maybe I'll further simplify. So again, the risk management committee will have an entire dashboard around that. But where is it trending towards? And where the effort should go, which risk to prioritize next time, which risk they are able to well manage. It can be managed at the middle level management or junior level management. I'll give you an example. So right now, for an IT company, talent availability and retention is a challenge. So this is an ABC company, and where is the competition standing? This is revenue, this is headcount. So this company has 11% risk, whereas competition has 13, 12, other or 10% risk. Okay, what is the employee satisfaction score? Okay, they don't carry out this exercise, whereas competition does carry out this exercise. Okay, this is a background to it. How you track it? Now, these are the risks they have identified. These are the mitigation plans they have identified. But then, what are the warning indicators? Every meeting they will track. On quarterly basis, they will track. What is their threshold limit? Okay, 8%. Management says, okay, 10%, we are good. Attrition 10% is good. Or in case of requisition, 30 days manpower requisition can be open. You have to define that. Beyond 30 days, maybe another 10 days is okay. 10 days here and there is okay. What is an actual value? Are they hiring people in 90-day cycle, 120-day cycle? What is the cost of resource? Ideally, cost of hiring should be within a month, maybe 10,000, or it can go up to 12,000. That is the tolerance management appetite. If it goes up to 20,000, then that is a challenge. Same case with attritions as well. So now the mechanism through which this is monitors are getting more robust. So any questions on that or on the process side of it? Should I move to next stage?
So there is one question which says that what is the velocity in enterprise risk management?
Velocity. See, velocity is something. See, cyber. You know what? You can envisage. Okay, with cyber attack, my system will be down by 3 days. I have a backup for it. So that is an impact. So you assess in a monetary terms. Okay, there is a business loss of X thing. That is an impact. Likelihood you can assess. Okay, with number of attacks been happening in your server. Okay, maybe we'll have one big incident once in 6 months, and you have to be prepared for it. But velocity, whether it will happen a first month or a third month or a 6th month, is very important. Because if you have a mitigation strategy which is only implemented on 3rd month, if something happens in 4th month, okay, that is also important. No? You have to that will decide how much impact it will have, because your mitigation plans only come in a later part.
Understood. And I guess basis that only we can decide the criteria of the risk, which is high, medium, low. Am I right?
Yeah.
Okay.
Yes.
Okay. So there's one more question which says that can succession planning be an enterprise risk? This is from Plaban. I wonder if Plaban is talking about Reliance, who will be the successor and all that. But yeah, the question is succession planning be the enterprise risk?
See, succession planning will be a risk. Many companies do say, but then it is management. How critical is it? Something like Reliance, succession planning, they have already decided, okay, for top management. If they have decided, it will be always a risk, succession planning. But is it high, medium, low impact? Is a going to question. Something like ITC has a very good corporate structure. They have a succession plan. TCS, they know their L1, L2, L3, all levels are decided. Then that is not a risk. But somebody in a proprietary concern, maybe Mufaddal Lal and company, or you don't know what is the succession planning. They are a promoter-driven organization. Then that will be a risk. So this is a platform that will help you have a discussion around it. Okay, management has to be okay. Succession planning in a TVS. TVS is a promoter-driven organization. I'm just maybe name is not important, but I don't really know the background. But then TVS, if today or Murugappa Group or some any, it's a promoter-driven organization. He is a decision maker, and then that is an important thing. Or maybe you have an expertise in a design level. You don't have a successor to it. Design of a product designing. Apple, there are a few designers who have. Then what is the succession plan for that? So these things you don't see from an internal perspective, but then you really put a strong questions to the management.
Absolutely right, sir. There are a couple of questions for PPT that can PPT be shared. So I believe the PPT will be uploaded on the portal, and participants can download that from that. Perfect. There's one very interesting question, and I'm also keen to listen that from you. That how can a chartered accountant play a role at CRO?
See, obviously, CRO, chartered accountant is made. This role is meant for a chartered accountant because they are the risk management experts. So first of all, but then it's very important. This is not just about financial risk. You have to build your sector capabilities. You have to build your technical capabilities, and you should have a rounded skills to know the business better and also perceive what are the external threats coming to it. So ideally, it's not just about finance. So you have to be more broad-minded rather than financial risk being your top priority. You have to understand the business first. Moment you understand business, you will understand the risk and how you communicate with the stakeholders. Because end of the day, they are the right person you have to meet. You have to meet the expectation. How you communicate with the senior management. Are you able to see the market trends? Then only you will be a good CRO. Otherwise, there is no requisite quality that only chartered accountants can be made or engineers can be made. No. Companies that haven't defined that, any qualifications to it.
Absolutely right, sir. And considering the opportunities right now in the market for risk and control environment, it is one of the best opportunity for chartered accountant to tap upon. Completely agree. That's it, sir. These are the questions. We can move ahead with the PPT.
So I'll just touch upon a few slides and then I'll wrap it up fast track. So we have seen, but the challenge where it lies is how it is implemented. I'll again say that is a big problem. Everyone knows everything. You can Google it out. You know, these are risk identification step, implementation is step, recording a step, but then these are the challenges we hear in the organization. They identify risk. Problem is HSC person will keep on telling health and safety environment is a big risk, but then is it aligned to your objectives? Are the risks too operational in nature, or and are they that is a problem when you have an internal scan and not an external scan. I'm doing a ERM for an aviation company. They will always see flight safety is a risk, fuel prices are a risk, but then competition may be also risk. You don't know what are tomorrow engine Boeing and Airbus, their business get disrupted. Your flights are of no use. You won't get any spare parts to it. But are there risks too short-sighted or long-term? Are you tracking emerging risks? Okay, are your risks linked to the business KPIs? Are this risk management activity is only limited to 2-3%, or your all middle management or senior management are involved? So these are some of the risks, whether you are internal looking or external looking, whether risk is a siloed one. You cannot have a solution to a risk if it's a siloed approach. Even department coordination is like attrition. It does not. You cannot say HR is responsible for it, and have an action plan that HR policy has to be updated. Maybe your branding is not good. People don't want to associate to your company. So these were the voice of the stakeholders we keep on hearing. So, and these are the models. Where are you? Are you seeing finance and only hazard risk or internal risk? How are you matured in your ERM framework? Are you only seeing traditional risk? Is it ERM a compliance exercise? Or you see only finance risk or functional risk is what you are able to track right now? You have to see more to it. You have to move up. You have to step up. Is there a centralized risk tracker? Is there a common understanding of risk? People have a different answer to what is risk. For different people, risk is a different meaning altogether. Is there governance structure to it? Is an internal audit also part of this activity in some in scoping of the whether there's a coordination between internal team and ERM team? Exercises are different, but then there is a communication between each of them. Are you quantifying risk or it's just a mere identification and discussion is happening around that? Next step comes where you ingrained everything, your processes, policies, everything talks about risk. Middle management knows something like risk. I'll tell you, risk culture is really important. Junior management is very risk conservative. They don't want to take a shot. Okay. They don't want to explore new markets. But senior management wants to explore new markets. So there's a disconnect. The risk culture is some senior management is risk aggressive, but junior management is risk conservative. You have to communicate. Senior management has to communicate these things to the junior management. There have to be early warning signals. Just writing a action plan timeline may not help. You have to have a tracking mechanism to it. Hope that from functional to coordinated to adaptive is the scheme of the game. Here it is a strategic risk management exercise, and business enterprise resilience is important. Now then it becomes a business management tool. Otherwise, you will keep on doing this compliance exercise. So these are things we see. People are geared up. They start annually. They do it again. It goes down. Annually they do it again. It goes down. Sometimes it starts but doesn't mature as an organization. They keep on doing it manually. There are no tangible dashboards. Technology interventions not happening. KPIs are not revised, revamped. Certainly, it may happen. Then there is an intervention. Okay, CEO wants it. It will shoot up again. It will go down. So we see ERM implementation as a major challenge. So there are ways to have a COSO framework that really guides you. Are your on this how to implement this entire ERM framework? I leave it right now, maybe for further questions, and maybe up next session we can talk how we should implement ERM and monitor the maturity of ERM framework. On maturity side, we can talk more in next sessions. Any question?
Yes, sir. There is one which says that please suggest the name of some good books that can be referred for ERM.
See, ERM, there are COSO standards and ISO 31000. So ideally, these are the two reference points. And you have to see, end of the day, whatever, I won't recommend a lot of books to it. You have, but then I do refer to a lot of YouTube sessions given by a lot of learneds. But then first, see COSO, PwC publication have given a publication on that. Deloitte have, many big fours have given publication on that. But then COSO is your go-to document for that. COSO will give you the principles and framework and components against which you have to implement this entire ERM. That is, I'll say COSO should be the go-to literature you should refer.
Perfect, sir. I don't think there are any further questions.
Well,
We can give like 2 minutes time for the participant if they want to post anything.
So just wanted a feedback and how I hope this session has been useful for everyone.
Absolutely, sir. I don't think any further questions are getting posted. We do have around like 250 participants, so that is a huge response we are getting, and participants are just increasing every minute. So I'm sure the feedback is very positive. Everyone is loving it, and thank you so much for those insightful knowledge which you have just shared. Firstly, thank you so much for sparing time, and it was just wonderful session.
Sure. Thanks first of all for giving this opportunity, and I'll share my contact number and everything in case people have doubt. They can WhatsApp me, reach out to LinkedIn as well. So I love to help people and make them aware on what is an ERM. ERM is really powerful tool, and I personally want we as a CA fraternity at least should look forward this CRO role. It's very powerful role. You will be there in a strategic role of the business. You are the go-to guy for the management. You have a complete view from the operations, finance, everything. Definitely, we should explore this as a new opportunity from a not just from a job opportunity point of view, but also excel in that profile as well.
Sure,
And
sure.
I'll be making if I work with international engaged clients, they're more keen to hire a ERM consult specialist over an I specialist. I specialist have internet specialists have their own value to the business, but then this is something more forward looking.
Absolutely, Sudhviji. I also want to thank you for all the participants for joining in, dialing in, and making this session a very engaging one. So far we got like 13 odd questions, 250 plus participants. So this is a really wonderful response. Additionally, I would like to extend my gratitude to the organizers and technical team for their efforts in making this webinar a smooth and successful event. And lastly, I'm also grateful to all the participants for their active participation. So thank you, everyone. And I believe we can have such wonderful, engaging events in future as well. So with that note, I think we can conclude the session.
Sure. Thanks again, Gopal, Rajendra ji, and Nanda ji and Aarti for the platform you have provided. I'll just type my details out there.